Hey guys, Toby Mathis here, and today we're going to go into the truth about trader status. And here's the scenario. Somebody spends $10,000, $20,000 a year running their investments. They go to their tax person and they say, I want to write these expenses off. And their tax person says, you cannot, because you do not qualify as something called trader status. So that is why I brought in an expert, Jeff Cottle, an attorney with Anderson Business Advisors. Jeff, first off, welcome.
Toby, thank you so much. Happy to be here.
All right. And you're going to enlighten us today on this thing called trader status. What's the difference between an investor and a trader, and why does it even matter? So what is trader status and why does it matter?
Awesome. Well, thank you so much, Toby. And that's a great place to start. Trader status is a status that you can elect or almost apply for, qualify for before the IRS, where you get to take your business expenses that you invest in or incur as a trader, and then you get to deduct them both against your trading income and against other income if you qualify. But that's the big key, is that if you qualify for trader status, and it can actually be very difficult. We'll talk about that here in a second, but that matters because most investors in the stock market now, they actually cannot write off their expenses. This is a change from the one big beautiful bill from last year, where at least we were allowed some expenses to deduct when serious investors incur those expenses. But now, like you just said, you can incur $10,000 and $20,000 in equipment and software and education and things like that. But if you don't qualify as a trader, those expenses are just lost. You do not get to deduct them.
Well, let's dive into that, because that sounds like the difference between somebody who might be a business versus an investor. Is there a distinction?
There is. So that's the big key for the trader status, is that somebody who qualifies as a trader then gets treated like a business. So they get to use Section 162 and they get to deduct their expenses against their income, all ordinary, reasonable, and necessary expenses related to their investing. In this case, it's really their trading, right? They get to deduct against their income. Versus an investor before the IRS, an investor is somebody who might purchase and hold long term, but the big difference is they do not get to deduct these expenses related to their investing because they don't qualify as a trade or business anymore.
All right. So you have investors at section 1202, and they get a very limited number of things they can write off, usually like margin interest, things like that. But if you qualify as a trader, then you're a business and you can write off ordinary necessary business expenses. Is that really the distinction?
That is the big distinction, is all ordinary, reasonable, necessary business expenses that you have related to your trading. If you qualify under this trader status, you get to write those off, which is a huge benefit. And it's why people think of this trader status as almost a holy grail, if you will, because this is the way they get to take all of those expenses, because investing and trading can incur a lot of expenses. Software and equipment alone can be tens of thousands of dollars. And those are deductible expenses if you qualify as a trader. But if not, then those expenses are just gone.
Oh, that's crazy. So let's just say that I make $30,000 a year in my account and I have $20,000 of expenses. I would think that I netted 10. What you're telling me is I'm going to pay tax on the entire 30, even though I spent 20. That sounds nuts.
It is. And it's a big, crazy change from the one big, beautiful bill that not a lot of people are talking about because of some of the other, honestly, benefits that came with it. But they're not talking about this loss of being able to deduct investment expenses. And so that's a really big key, is that going forward, investors, they really don't have a way to deduct this. Well, at least not without careful planning. There is a way we can get around trader status for investors using business entities. And we'll talk about that here in a minute, I think, too.
All right, before we get into theirs, let's just talk about investor and trader. And it sounds like, is there a statute on trader status? Like, here's what you have to do to qualify? Or, how do you even figure out whether this is something that applies to you?
Yeah, that's a great question. The IRS has put out some guidance, but it's very, very subjective. And guidance meaning guidance onto who qualifies as a trader or who does not, right? That trader tax status. And so the guidance, it goes through and it lists a few different factors, but they're all kind of, for lack of a better way to say it, they're all kind of squishy factors. The IRS has said that they will take into consideration the frequency of the trades, the amount of money at risk, and that they will also take into consideration if somebody is using it as a primary source of income to pay for their day-to-day expenses, and the amount of time that they spend on it is really, really big. We have seen, 1,000+ trades per year is kind of a soft benchmark, but again, that's not a hard benchmark at all. That's just one that says, okay, that person now might qualify if they meet these other sort of standards. Another big one that the IRS has talked about is that the average trade or the average hold must have less than 30 days on average holding your position. And that's one that can trip people up a lot, because you might trade yourself, might go through clicking things frequently and have a whole bunch of different positions open. But if they average more than 30 days, then that might be trouble. And so it's really a very difficult status to actually qualify for, because the IRS has slanted it in their favor with these sort of soft benchmarks or statuses that they will analyze there. They can sort of claim anybody, or perhaps a better way to say it is they can claim nobody has qualified when they go to tax court to argue about it, because there's no real hard, bright line for when somebody does or does not qualify.
You just mentioned tax courts. Like, is there not you have to go to tax court to figure out whether or not you qualify as a trader?
Basically, yeah. Again, because of no hard or bright line standard there, if it gets audited, there's no way to prove it one way or the other. So yeah, very frequently does just end up in tax court, which for a host of other reasons too is a nightmare on top of losing your deductible expenses that you worked so hard to gain and that you were kind of counting on and planning on in your tax planning. So it can be a nightmare for several different reasons, not the least of which is that the IRS just has the advantage when you get there.
All right. So let's say that we have somebody that they're an active investor, like they're trading on a daily basis, and they think that they qualify as a trader, and so they go to their accountant, and what does the accountant do? Just write trader on their return or something and file it under Schedule C and say, hey, we're going to take your expenses over here. If somebody does that,
Mm-hmm.
what is the common reason that the IRS comes through and says, no, you're not?
The common reason I alluded to earlier, there are a couple of them, right? There's amount of money at risk, or perhaps there's the portion of your income that comes from trading. Those are two factors that are analyzed. But the big one that comes up very frequently is the one I alluded to, which is that 30-day. That's kind of a hard line. It's not really a hard line. Like I said, there are no real super bright lines, but it is one that comes up very frequently, that hey, this is a cutoff here. If your average position is open, or if you're holding something for on average 30 days or more, then we're just going to say no almost automatically, right? And so it becomes a hard line or a bright line in the sense that, hey, even if you're on the markets, you're trading every day, you're making purchases, or you've got options open or whatever else, but you don't exercise them for more than 30 days, then you've kind of shot yourself in the foot, at least for qualifying for this status. And I want to be clear, like, you can still make a bunch of money, but if we're talking about qualifying for trader tax status, that's a big one that catches a lot of people, because they're thinking, oh, I'm spending all this time, I'm spending all this money and working on it. But if your positions are open for that long, more than 30 days, kind of just blows off everything else.
All right. So let's just say that I do qualify as trader. And again, I believe that this is accurate. I think that you're filing your gains on Schedule D on a 1040, but you're filing a Schedule C, and you're saying I'm in the business of a trade or business as a trader. What kind of expenses do you get to write off if you are a trader? Like, is this something where it's like the holy grail, like you mentioned, or is this something where it's like, oh, okay, yeah, there's a few things, but it's not exclusive?
Yeah, that's a good question. So it's kind of a mix of both. People treat it like the holy grail because then you can write off some very particular expensive items, right? So your equipment and your software, especially if your internet bill portion of that, right? Home office, those kind of things can be written off if you have your trader tax status. So a lot of people will spend a very large amount of money on software and on computer equipment, right? So they can be up to the second.
What are these guys? Your cell phone and your data.
Right. Exactly. And so those kind of things you can write off. And that's why people like the trader tax status so much, is because those specific items, they can be very expensive. And it's also true, though, that there are other expenses, if you're a small business owner, if you have, say, a corporation set up elsewhere, there are other expenses that would be available, say, to a corporation that are not to somebody who's just an individual human who qualifies under trader tax status. So it's kind of a mix of both, right? There are some very key expenses that the trader tax status allows access to and allows to be deductible, but it's certainly not everything that perhaps a full business entity or corporation would have access to.
Okay, let's turn this around. So my experience with active traders is about 90% of them lose their butts, like they lose money. And so these people are out there trying to time the market, and I'm not a big fan of that. But if you're doing it, God bless you. Good luck.
Right.
But it's like going to the casino and being a professional gambler. Right? 90% of the people get just steamrolled, and then there's a few people that actually make money at it. What if you lose money as a trader? Do you get to write that off as a ordinary loss? Can you use it against your W-2, or is it still capital loss?
Thank you. That's a good question. Appreciate you bringing that up. So yes, I didn't mention that before, but that is one of the big expenses you can write off. Expenses, right? Your losses. If you're trading and you're actively engaging in day trades, trying to time everything right, and you lose money, which a lot of people do, if you have trader tax status, then yes, you can offset that against other income. But if you don't qualify as a trader, then it can be more difficult, right? Because then it counts as capital gains or losses. In this case, like you're talking about, it's capital instead.
Well, is that automatic, or do you have to make a special election? So if I'm a trader
where you make
myself, like if I'm just a trader and I lose money, let's just say that I elect trader status and I lose $10,000, that would be capital loss. Normally, like if I'm an investor, it's capital loss for sure, and I'm limited to what offsetting my other capital gains, or I get $3,000 a year. But if I'm a trader, I think I'm still subject to that rule unless I make
that's right. Sorry, make the mark-to-market election. So what you've got there then is your mark-to-market election is where you elect to say, hey, functionally what it is at the end of each year, you are taxed on whatever your positions are or whatever the value of any stocks you've invested in, things like that. You're taxed as if you've liquidated everything, even if you haven't. And if you make this mark-to-market election, this is again helpful because it can help you offset or take those losses and offset them against other income. But it can also be harmful because it increases the odds that you just lose money on the market if there's a big fluctuation when it actually comes time to pay the tax bill.
Yeah, explain that. So if I have a stock that runs up in December, and I mean, I've seen this a number of times. I don't know if you've seen it, but you see somebody that in November and December, they have the Christmas rally, and then that just tanks the following year. You still have to pay tax on it, even if selling the stock wouldn't even cover the tax bill. Do you still have to pay that tax bill?
Yes, and this is a huge risk that comes together with mark-to-market and with trader tax status. And it is exactly that. And people are very frequently surprised when they hear about it. They'll say like, oh, come tax time in either March or April, usually April in this case, they'll say, hey, and so my stock, it was worth $150, just using a random simple number, $150 at the end of the year. But now in April, it's only priced at 100 or 90 or 80 or whatever it is. It's lost some value. You're still taxed if you're making mark-to-market election there. You're still taxed as if it was worth that full 150 because that was the price, that was the value at the end of the year on December 31st. This actually happened a few years ago with a very well-known and relatively safe or considered safe, right, stock in Amazon, where come close of the year, I want to say they were around 225 a few years back, come close of the year, and that's great. However, when April hit, it was all the way down below 200. It was 180 or something in that range. I have a screenshot of it we'll share here in a second. But what that means then is that if somebody is heavily invested in Amazon and they've made that mark-to-market election, then they are treated as if they liquidated their entire portfolio there at that 225 price or whatever it was. But then come tax time in April, when the stock may be down to 195, 190, 185, then they have to pay taxes as if it's at 225. And very frequently, people are actually liquidating these stocks in order to pay those taxes. And so somebody is selling Amazon now at a loss in order to pay taxes on what would have been a gain if it had stayed up at that higher price at the end of the year. And there have been a couple of times in the dot-com boom, for example, or the dot-com bubble popping, where people have lost a lot and a lot and a lot of money because something like this happened, like in the early 2000s.
Yeah, I remember when Qualcomm shot up in November and December. I think it was 99 or 2000, and that just tanked. And I remember people were having the conversation, well, I'm just going to file an extension, not pay my taxes. I'll pay that little bit of interest because the stock had gone down so much. And then by the time just October rolled around, it was down even more. And
it was even worse. Yes, that's what I was going to say. I was like, I think I remember it was even worse when the extension deadline came around.
And they got hammered. But so if you're playing along at home, let's just kind of go to there's one column where it's you're an investor and you get Section 212 and the Tax Cut and Jobs Act and the one big beautiful bill nuked miscellaneous itemized deductions. You're kind of limited. You don't get ordinary necessary business expenses. Then you have the next column is trader status. You get to go to court and try to prove your case, but you get business deductions, but your losses are still capital. Then you have a third column, which is trader status with mark to market, where you get the business 162 business expenses, but your losses can be used as ordinary loss. But there's these drawbacks of doing that, where you could end up paying tax on things that you lost money on. And by the way, mark to market means you liquidate at the end of every year, which means you can't have long-term capital gains because you can never hold for more than a year. So that kind of sucks. And in all of those cases, you're like fighting in court. Is there an alternative? So I do not have to do that. Like make that a fourth column. Here's the unicorn. Here's the special treatment to this so you don't have to deal with the other three.
Absolutely there is. And that unicorn is the one that you and I kind of alluded to earlier. And that's using business entities instead, where we say, okay, we can get those Section 162 business deductions, but we are not going to use that trader tax status. We're not going to have to take the risk of using mark to market, but instead we will actually use, in this case, it sounds a little redundant, but it's true, we will use a business entity in order to get those business deductions. Most frequently, this business entity will actually be a C corporation or an LLC with a C corporation election. And the reason for that is because money that flows into the C corporation actually can take all of those expenses, we call it CORN, right? Common, ordinary, reasonable, and necessary, without you having to qualify for that trader tax status, without having to go to court, and without having to take the risk of the mark-to-market election.
So would you hold the trading account in a entity that is managed by the corporation, and the corporation is paid to manage that? So the corporation is not trading, the corporation is actually managing the account, managing the investments, but it is a true management entity. It's the family office, so to speak, and then you have your other investment accounts. Maybe you have stock accounts, maybe you have real estate, maybe you have other business interests, but this corporation is then just using it as a tool to generate income, sometimes through maybe something called a guaranteed payment to partner, and maybe it's getting a piece of the action. It's also an owner. Is that what you're talking about?
Yes, that's exactly right. So let's break this down, and the way you've described it is excellent. And the way it works is, what Toby said is perfect in the sense that the corporation itself, the reason this works so well is because the corporation itself does not actually own the account. I know I just said, hey, we'll use a corporation. Let's be clear about how we're using it now. Is we use the corporation as a management company. The corporation does not actually own the stocks itself. But instead, as a management company, it can receive fees for services that it is providing. And so in this case, what we do, this is a simplistic example. Everybody's structure will be a little different, but the very basic idea is we'll have an LLC or a limited partnership that owns a trading account, a brokerage account, might own some real estate through some child companies or whatever else. But then in this case, it would send management fees over to the C corporation, or LLC taxes the C corporation, right? And then by doing so, this C corporation has access to all of those common, ordinary, reasonable, necessary expenses, but it does so again without you having to qualify as trader tax status or having to make that mark-to-market election. And this is especially true in the case of our traders, is we can go even further and say that the C corporation has a partial ownership interest in the entity that actually does own your accounts. And so that's the big key, is that the LLC or the limited partnership, like I said, would own the accounts. And let's say that the C corporation is a 10% partner. So then it receives 10% of that income automatically, and then can use that to pay for expenses and not have to go through all the nightmare of arguing in favor of that trader tax status and not having to deal with the risks of mark-to-market election. We just send the money over. You could call it income shifting loosely, if you will, but send the money over to that C corporation where we have additional deductible expenses available there.
And let's just kind of make this real. So let's say somebody's making profit at $10,000 a year and they have $10,000 of expenses. That $10,000 is going to be worth whatever is their tax bracket. So let's say that they're an investor and they're disallowed the 10,000. They basically break even, but
yeah, I was gonna say basically it's zero at that point.
Yeah, the tax benefit's not much. I guess even if they're in the top bracket, it's like $370 or 30. What is it? 37%. Actually, if it was $10,000, it'd be worth $3,700.
Yeah, $3,700. Yeah, exactly.
If it was $1,000 of expenses, it'd only be worth $370. So I guess around $10,000, it really starts to hurt a little bit not to get to write that off. And you're like, gosh darn it, but I don't want to do the whole trader stuff because it sounds like that's a horrible idea. Like, trader, let's go to court. Let's fight with the IRS. Let's do facts and circumstances. I can just tell you that's not something I'd want to do, but maybe some of you guys are out there like, no, this is what I do for a living. And you feel like you're going to withstand that scrutiny. There's people making $15 million a year that lost. There's people that made their living in the market who lost because they took too many vacations. That's the Chen case. But like, there's all these different cases out there where it's like, they find a way to get you, or you do this. Now, let's say that I'm making $30,000 in profits off of my trading, and maybe a lot of it's long term, maybe some of it's short term. And the corporation, you said 10%, so it would get $3,000. Is there another way? Let's just assume that I had $15,000 of expenses. I had my computer, my home office, my cell phone. I went to a few courses. I went to some workshops. I went to some seminars. I went to whatever. And I maybe I have some coaching, and I spent money of $15,000 in the year. So I would say I have $15,000 of expenses, but the corporation only got $3,000 under that scenario. How do I get more money to the corporation so it could pay those expenses?
Yeah, great question. So you and I have both kind of danced around this, but what we do is we send more money over as a fee for services. We use a management agreement, and in partnership tax lingo, it's called a guaranteed payment to partner, where what happens is we set up a management agreement, and the management agreement says something to the effect of, hey, the manager, in this case the C corporation, is providing services over here for the LLC or the partnership that owns the actual brokerage account where the trading is happening. And we say in that agreement that, hey, this payment for management services is guaranteed. It's not based on the amount of net income that's in there or anything like that. Without diving too far into the weeds, this allows this guaranteed payment to partner over here to become then active or earned income over in the C corporation. And then we can get more income. So it might be, let's say we have, again, 10% going over to the C corporation, but we have, here's a big hit, we have some medical expenses. Say we have small kids who are constantly jumping off of stuff, or let's say we have pre-existing medical conditions. Under the C corporation, you can write those off. Those are tax deductible. And so then what happens is we say, hey, we have some uncommon medical expenses this year, or like Toby said, we've paid for some equipment, we've gone to some seminars, we paid for some classes. And so we have a lot more money. Well, let's use that management agreement, that guaranteed payment to partner, and send additional money over to the C corporation so that we make sure we cover all of those expenses. It's a great way to go without us having to constantly be changing the ownership, 10% or 15 or 20 or whatever else it is, because that's annoying, and it also looks really fishy. And so then we avoid all of that by using that guaranteed payment to partner through the management agreement instead.
And so is it possible, let's just say that you paid the corporation, I don't know, $2,000 a month to manage and to do everything. You sent it $24,000 and my example, there was $30,000 made. So $24,000 goes over the corporation and you expense it all out and it comes back into your own pocket. And then that means 24 minus 30, there was $6,000 that were actually made. So the corporation would get another $600 and you'd only have to pay tax on what, $5,400?
Yeah, basically. And so then that way, if we're sending all of that money over, pay for all of these expenses over here, it's tax deductible, comes back into your pocket this way using the corporation, whether it pays for those expenses or whether it's reimbursing you tax free, get that money back in your pocket, and then you pay for whatever is left over, pay taxes on, whatever is left over here in that LLC or that partnership. That flows through to you. But yeah, there's a world where if we have $30,000 of income, but $24,000 in expenses, we're only paying taxes on a very small portion anymore.
Wow. As long as it's reasonable and necessary and you're documenting this
Yes.
stuff and you're working with somebody like Jeff, which by the way, if you want to work with somebody like Jeff, type in consult down in the comments below and we'll send you a link so that you can set a time to talk to somebody like Jeff so that you can actually see whether this is a benefit. There are nuances here. We are giving you the 10,000 foot view, but there are nuances. You want to make sure that you dot your I's and cross your T's. All right, Jeff, just because I know that there are lots of other benefits to using some sort of entity structure, what are the other benefits that we're not even talking about beyond just the tax benefits?
Yeah, great question. And so the other big thing that we have not even touched on yet, and the tax benefits are already worth it in and of themselves for sure. But we haven't even touched on, though, the asset protection side. If we use an LLC or a limited partnership to hold the account in a state that has good protection, frequently that might be Wyoming. There are other states, but Wyoming very frequently will use. Then you get protection in court as well for your accounts because brokerage accounts, trading accounts, because they're so liquid or almost liquid, they are very attractive targets for attorneys, say personal injury attorneys or other people coming around, creditors, right? And so what happens then is if we put these accounts into an LLC, then we have protection and they cannot be touched related to liability outside of that LLC or that limited partnership. And so this is a huge other benefit because if we've got, tens or hundreds of thousands of dollars or even millions in these accounts, then those are shielded from creditors. And it's set up properly, they can be anonymous too, so that in the event that we have outside liability for whatever it is, right? In a car accident, child in a car accident, dealing with a business dispute or whatever else might happen, those accounts are protected from lawsuit and from creditors.
So you're telling me that if I have a brokerage account in let's say a limited liability company in Wyoming, and it's managed by a corporation that's a separate LLC or just traditional Inc., that $1 million, let's say I had a bad car accident, or let's say, God forbid, one of my kids got into a car accident, those monies would actually be protected?
That's correct. If it's set up properly, and like Toby said, got to work with somebody who knows what they're doing. But yes, set up properly maintained. Yes, we've had clients who have had outside liability and have had brokerage accounts. I can think of a couple of them that were in Wyoming LLCs that were not touched, even though they were ultimately held liable. And so that's a very important factor, is not only are we getting tax benefits, but you also get the protection from creditors and from lawsuits if you structure it and maintain it correctly.
Now, something happens to me and I pass away. What happens to that? Is it something that is, oh no, now we made a mess? Or is this something that works well with an estate plan too?
It absolutely works well with an estate plan. We can say, hey, the key part of any estate plan is going to be our living trust. That's going to be our baseline. Very easy to put a limited partnership or an LLC, limited liability company, into a living trust so that both that LLC itself and the assets that it owns pass through to your beneficiaries, whoever they may be, right? Children, family members, friends, even charities, whoever you designate. They pass through according to the terms of that living trust without needing to go through probate. Again, if it's structured properly, yeah, absolutely. It fits in very well with an estate plan.
All right. Is there anything that we're missing here? Because it sounds like we went over investor versus trader with mark to market, and then the kind of the unicorn, the thing that you can do to avoid having to go to court and dealing with a bunch of nastiness. Is there anything that we're missing in this conversation?
As far as the 10,000 foot overview goes, we've covered most of the basic topics here, and as well as the benefits related to asset protection and estate planning as well. So was there anything else that you wanted to make sure we touch on for everyone listening?
No, I would just say that if somebody needs to, wants to talk and see whether it's something that applies to them and what kind of benefits, usually it's, I do the old, is the juice worth the squeeze? Well, you kind of have to calculate things to figure out whether that makes sense. And you look at all the ancillary benefits. For some of you guys that are sitting on large accounts, it absolutely makes sense, not just from a tax standpoint, but from an asset protection standpoint, from a legacy standpoint. For other people that are like, hey, I need to keep track of every penny, and I need to make sure that I'm not just leaving money on the table and paying unneeded taxes. It makes sense for you guys to go through and run that as well. Type consult down below. Jeff and his team will be notified, and you can sit down and talk to somebody who really knows their stuff to see whether or not this makes sense.
Perfect. Thank you so much, Toby. Always a pleasure.
Perfect.